If you take an analogy in sort of like a specialized hedge fund versus an index fund, do you think that's a fair analogy on SFL, just given that, since it's a more broad portfolio, you maybe don't get the huge swings on the up and down side, but you get more stable, growth trajectory? Or do you think that analogy is not fair at all?
Well, I mean, we don't hedge in the form of shorting, so we don't go long one sector and short another. I mean, we don't invest. That's how we try to do it, and we try to be careful. And I think one of the benefits of looking at multiple segments at one time is that you sometimes see patterns in segments. For instance, if one segment is rallying, and we know that from the past that it's typically in the peak markets. That's when the capital market is open. And the reason why, and that's when you can therefore do deals, and that's where if you are focused on one single segment alone, you're almost programmed to invest at the peak. And sort of the good old shipping 101 is buy at the bottom, sell at the peak, or as close as you can get. But in reality, for the companies in I would say listed companies who are in the capital markets, they're almost programmed to do the opposite. Because they have to follow the market and they have to put money to use when money is available in the market. So that's one of the things we try to counterweight in SFL. So at any given time, we will look at deals in the container space, in the tanker space, in the dry bulk space, and also we've done some deals in the offshore space. So it's all about trying to balance it, trying to find the right risk-reward mix. And invest with a long time horizon.
Can you talk a bit about the asset classes and the weighted portfolio, because it has changed over time, right? And right now it's very many liners and container ships you are releasing out, etc., and buying. So how do you calculate that? Because is there like a strong correlation in how much percentage? Do you balance the percentage as a hedge fund guy would do if he was an asset class investor? Or do it always comes back to, is this the right deal? Then we'll take it. Or is it, even if it's a great deal, you can't take it because the portfolio then gets outweighed in terms of what you want to have in your portfolio? How does that work?
Yeah, I think if you start planning with a certain percentage in each segment, it's a recipe for disaster. It's all about trying to do the right deals at the right time, and that's where that's one of the benefits of looking at several segments is that we can try to look at the segment. If one segment is red hot, i.e., values have gone sky high, then you can pull back and you focus more on other sectors. If you look at our portfolio mix, it's been a very interesting change over the years. Back from the start, 2004, SFL was a spin-off from Frontline. We owned only tanker assets. We had 47 or 48, I believe, at the beginning, we're basically a captive financing arm of Frontline. Back then, this was actually, I would say a very, very smart move. This was on the back of, the baby boomers in the US, where you saw a shift from call it classic sort of value and growth stocks to more dividend type stocks. You saw the hotel industry, for instance, where you have a distinct different ownership in the real estate and in the operating companies. Sort of OpCo, PropCo type mix. But in the shipping, all shipping companies own their assets and run them in the market. So the question that Mr. Fredriksen and his co-workers then had was, why doesn't this work in shipping? Why don't you have the same OpCo, PropCo separation? And how can you attract a different set of investors in the shipping community compared to the hedge funds of the world who normally have invested in the shipping space? So SFL was created, I would say, as a first in the maritime space. A couple came later. You have MLPs who have, I would say, sort of similar characteristics. But I think SFL, what differentiated SFL was that it was set up not to be exploited or not to be just a sort of a drop-down type vehicle where, call it the principal sort of investor, could gain a nice profit. It was set up to be independently, call it profitable with a profit share mechanism relating to the tanker market at the time.
It's very interesting because if you look at the homepage, it says like 3 keywords. It's growth, profits, and dividends.
Yeah.
Is that sort of like the most simple way to describe the company? If you manage to do those 3 things, that's basically the job.
Yeah, absolutely. So if you go down back to the tanker side, we started in tankers, started investing in also in other sectors, and I joined in 2006, first as CFO and then as CEO from 2009. So when we joined, it was a year or two without much activity in the company itself. It was really managed by Frontline. So then a management team was brought in to set up, to really develop the company into, to do something more out of that, call it vehicle, that the SFL had become at that time. So then we embarked on a strategy where we diversified the portfolio. We invested also in other segments. So by 2009, we had more in the offshore space than we had in the tanker space. At that time, we had close to 60% of our portfolio in the offshore space. We had a lot of tankers, of course, and very limited container ships and just a small portion of dry bulk. So zooming forward, now we have much more in the container space. We don't have much in the offshore space. And, interestingly enough, just 2 weeks ago, we announced the sale of the 2 final Frontline vessels. So no, we have no vessels left from Frontline from when the company started. So it's transformed itself. Maybe also illustrating, the boom-bust dynamics of shipping. We started as a captive financing arm of Frontline in 2004. In 2011, because of the financial crisis or the crisis in the tanker market, we ended up being the largest investor in Frontline. So at the time, and then for those who remember, old Frontline was merged with Frontline 2020, and of course it became a very different and much bigger entity after that. But just illustrating the dynamics, in the market.
What has been the worst investment you've made during your SFL time?
Good question. Of course, you would hope that you shouldn't have remembered it, but of course you do. And I would say, as a business mentality, you should be focused on what you've done wrong. Simply to understand the dynamics of how the market works. I think the worst investments is probably a drilling rig that we bought for $850 million in 2008. We earned a lot of money on it because we have a very front-loaded charter, payment structure on that. So we basically recouped most of the money without any return, but we ended up scrapping it, in 2021, just 13 years old, and got next to nothing, i.e., recycling value for that after such short period. Of course, many years that market was booming. That rig was chartered to Seadrill at the time. The head charter was phenomenal. It was at 6 years to Petrobras at $640,000 per day. It was just insane, call it net cash flow. But unfortunately, when the offshore market crashed, it had to be laid up and in the end recycled. So, but I'm sure there are many other investments that could have been better. But it's also investments that I would say may during the life cycle of that investment might have looked like, oops, this could be an issue, and where the market pops back up again. For instance, we have some container ship investments with that type of characteristics.